The global luxury watch market has just gone through one of the most dramatic corrections in its history. For nearly a decade, prices didn't seem to obey gravity. Steel sports watches were treated like financial assets. Dealers told buyers that demand would never slow down. Social media created the illusion that everyone was getting rich just by owning the right models. But in 2024, reality arrived. What followed wasn't a small pullback. It was a structural breakdown that wiped out hundreds of millions of dollars in speculative value. And the most shocking part is that it wasn't caused by the watch industry at all. It was triggered by a financial crisis happening thousands of miles away. To understand what happened, you have to look at where most of the demand was really coming from. For years, Greater China was the engine of global luxury consumption. Collectors in mainland China, Hong Kong, and surrounding regions absorbed enormous volumes of high-end watches. They weren't just buying to wear. Many were buying as a way to store wealth. Watches became a form of portable capital, something that could be moved, sold, or traded quickly. But that system depended on one thing: constant liquidity. When China's real estate market began to unravel, that liquidity vanished. Property had been the primary store of wealth for millions of affluent families. When developers collapsed and housing prices began falling, people were forced to cover debts, margin calls, and business losses. And when that happens, luxury assets get sold first. Watches were dumped into the market in massive numbers. This wasn't people losing interest. It was people being forced to sell. You can see it clearly in the export data. Swiss watch shipments to mainland China dropped sharply, while Hong Kong, one of the world's biggest luxury resale hubs, saw double-digit declines. When financial stress hits, items that are expensive, visible, and easy to convert into cash are the first to go. Luxury watches check all three boxes. This wave of forced selling flooded the global gray market with supply. Prices collapsed. Nowhere was this more visible than with the Rolex Daytona. For years, it was the symbol of the hype cycle. A steel chronograph that sold at retail for around $15,000 was being traded for over $50,000 at the peak. It wasn't because the watch became better, it was because speculation made it scarce. Once the selling started, that illusion broke. Within just a few years, those same Daytonas lost nearly half their market value. Submariners, GMTs, and other steel sports models followed the same path. The most famous collector trio, the Nautilus, Royal Oak Jumbo, and Daytona Panda, dropped by tens of thousands of dollars each. These weren't normal luxury price movements. They were asset bubbles popping. But here's what most people missed. The entire watch market didn't crash. It separated. We are now in a two-speed market. On one side are the high-volume steel models, whose scarcity was artificially created by waitlists and flipping. Those watches lost their premiums because the profit opportunity vanished. Many are now trading close to retail or even below. On the other side are watches that are actually rare. Low production references, unique dial variations, precious metal sports models, and discontinued designs have held their ground, and in some cases gained value. That proves something important. Real collectors never disappeared. Only the speculators did. The waitlist system depended on guaranteed profit. Once you could no longer buy at retail and flip for easy money, there was no reason to hoard inventory. That single shift dismantled the entire structure. At the same time, reports of hidden stockpiles and liquidation inventory destroyed the myth that supply was permanently restricted. Once people realized that thousands of watches could appear on the market almost overnight, the scarcity premium collapsed. There was also a cultural shift underway in China. Highly visible luxury is no longer as socially safe as it once was. Political pressure and changing attitudes have pushed wealthy consumers toward subtle, discreet expressions of wealth. Watches that scream status have become less attractive, while understated craftsmanship has become more desirable. That creates a structural problem for globally recognizable brands whose value was tied to being instantly noticed. Yet despite all the chaos, something healthy is happening. Speculation is being removed. Price indexes suggest the sharpest declines are slowing. Markets are stabilizing at more realistic levels. The people still buying today aren't flippers. They're enthusiasts who actually want to wear what they buy. That's what a real collector market looks like. The Rolex crash wasn't the collapse of luxury. It was the collapse of financial fantasy. Steel sports watches were treated like stocks and cryptocurrencies, and eventually the math stopped working. China's economic crisis simply exposed how fragile the system really was. Now, the market is doing what it always does after a bubble. It's separating real value from artificial hype. So here's the real question for the next 5 years. Would you rather own a mass-produced steel watch that just came out of a speculative crash, or a genuinely rare piece that held its value even during the chaos? Let me know what you think.